Hello, everyone. I'm Arvind Chari. I'm the Chief Investment Officer at Q India UK, which is an affiliate of Quantum Advisors Private Limited India, which is, of course, the sponsor for the Quantum Mutual Fund in Bombay. Today, I thought I will talk to you about the year gone by. And as you know, India follows a fiscal year of April to March. So we'll just look at how different asset classes and markets panned out in India over the last 1 year period, April 22 to March 23. If I look at equity markets and if I compare India as compared to other global markets, of course, it was a down year. Equities overall have been underperforming globally. So if I look at the MSCI India over a 12-month period ending March 2023, in dollar terms, MSCI India fell by about 13%, very similar to what the MSCI Emerging Market Index fell. So of course, India was outperforming between 18, 19, 20, 21, but that outperformance has kind of narrowed in the sense that India has fallen as much as the Emerging Market Index. If I look at the NASDAQ, which also had a similar minus 14% return for a 12-month period ending March 2023. But if I look at near term, last 6 months, last 3 months, India markets in dollar terms has actually fallen way more than emerging markets. For example, the MSCI India in dollar terms in the last 6 months is about down about 5%, whereas the emerging market index was up 13%. If the European index was, for example, was about 30% in the last 6 months till March. We've seen a similar recovery in markets in the US market as well. Dow Jones and NASDAQ both had about 15% return. So that's just showing that although sentiment towards India remains, very, very popular, people are looking to invest in India, but the actual returns in the last 6 months has kind of been a big divergence. So much to the extent that India had such a large outperformance against emerging markets and against China that has narrowed considerably in the last 6 months. Of course, April has been a bit different. India has done reasonably okay, but this is how things have panned out in the last 3 to 6 months. If I look at within India also, if I compare Sensex as compared to say the mid cap index or small cap index in the last 6 months, the large cap and mid cap has actually fallen more than the Sensex and Nifty indices. And if you go away from the index, if I speak to people who have a lot of allocations in Indian mid cap, small cap portfolio positions, there the bleed is even higher. So index is masking the actual extent of the pain that some investors will have on their portfolio, or some asset managers who are running very high growth, high momentum strategies. They've seen a significant decline in their NAV and in their share prices. So it's been a mixed market. We can have multiple reasons. One is purely valuation. India was so much more overvalued as relatively as compared to other markets, that we've seen this continued selling by foreign investors in Indian equities. So especially global emerging market funds, which are a very large allocation to India, have been reducing the allocation to India and allocating to maybe China, to other emerging markets, which are relatively cheaper. So that's been a continued trend. It's been almost non-stop for the last 1.5 years, where foreigners have sold almost about $30 billion in the Indian equity markets, purely to do with the fact that India has relatively outperformed and was relatively overvalued. And maybe we are seeing the trough of it because so much outflows have happened. But that is one very quick particular reason. Second could be just the growth. Although India has recovered well, but the recovery is still not complete. We are still seeing consumer segments, be it durables, be it discretionary, be it consumer staples, where companies are reporting slower volume growth than what the market was pricing. That's also a reflective in many small cap, mid cap companies as well, where the growth numbers have disappointed and we've seen a sharp reduction in prices. In the very short term, we would believe monsoon tends to be a big key, although lower monsoon does not necessarily impact food production. But we have to still wait and see how this pans out, especially given the fact that the consumption recovery is now very much dependent on the agriculture and rural as compared to government's efforts or a very large capex cycle, which we are still seeing it to be delayed. So if the monsoon pans out well, farmer income should be okay and rural economy should be get benefited. If it is very drastically lower, which impacts food production, then you will see an increase in food prices, which could have inflation impact, and then RBI will have to act through increasing interest rates. So short term, that is the biggest key to watch in India as compared to other global markets. The second big factor, which is not short term, but it's like a more medium term in the sense that up to the next 1 year, there are many state elections, very large states coming into elections, which will drive the mood sentiment of the nation towards what is going to happen in 2024 when we come ahead, when the general elections happen. So till that time, pockets of uncertainty, depending on where political news flows pan out, that will also tend to have impact. But if I look at, as I said, as I've been saying, over the medium to long term, as I speak to many pension funds or institutional investors and sovereign wealth funds, I do sense a feeling that many of them will have a dedicated India allocation, right? And so if India does not massively disappoint on politics or geopolitics or on the economy, you should assume and expect a lot of dedicated India flows coming across asset classes, equities, fixed income, real estate, private equity, in all four spaces. We should also expect, as Indian markets correct relatively as compared to global or emerging market peers, you should see the outflows that global emerging market funds have. They should start coming and buying back, or as they see valuations correcting, and as they see if the Indian economy really recovers to that 6.5% long-term real GDP number, you should see valuations getting a lot attractive. From a global perspective, we were very clear that the US banking system issue is not systemic, in the sense that the Fed had enough arsenal and power to manage that situation, right? So I think that view has kind of prevailed, where that specific 2-3 bank issue has not become a contagion, and the Fed very quickly moved to fix that issue, and the rest of the banking system seems to be okay. They are now torn between, should they focus on inflation or should they focus on financial stability? And I think this will be the issue to see and pan out, not only in the US, but globally. We've seen that with the RBI. The RBI has paused. They did not hike interest rates in April, saying that they are pausing to see the impact of what they have done before, and whether it is enough for them to manage inflation and at the same time keep supporting growth. And we believe we are very, very close. I don't think the RBI needs to hike anymore. They can leave the repo rate at 6.5%. Forward inflation projection is about between 5 and 5.5. So what we call real rates, interest rates minus inflation, is very much into positive territory across the Indian deposits, repo rate, as well as the bond market. And I think that should be enough to control inflation. Also, as I said, in India, it is still not a consumption-driven recovery. We still don't see consumer economy. People's incomes are still lower. Employment is still not back. And we don't see too much demand-led impulses. So interest rates could remain where they are, which is attractive from the bond market perspective. If you see last 1 year, your bank savings account might have underperformed to a liquid fund. And not only in India, but globally, right? If you put money in a global money market fund, that returns is slightly better or much better than what your bank savings account typically offers you. And that's something that's played out in India as well. India long-term interest rates are at above long-term averages. So if you look at the 10-year bond yield at about 7.25, 7.30, is at about its long-term 10-year, 20-year average. Similarly with the repo rate and similarly with inflation, India's long-term inflation average CPI is about 5.5%. And that's where the inflation numbers are about to settle. As compared to the global market, where long-term inflation in global markets, developed markets, is 2%, interest rates are at 4%, and current inflation is closer to 6%. So they still have some amount of adjustment. Whereas Indian companies, Indian households, Indian government, it has always seen these kind of interest rates and inflation and managed their business as they could. So from that perspective, India is slightly better off in this overall emerging global scenario of financial stability at one hand, and inflation and interest rates as a problem on the other hand. So we will see how things pan out. from the way we look at how we manage money, especially in the equity markets, we are seeing value not only in the index but outside the index, in certain sectors, in certain businesses. And as if the equity markets keep correcting, you would expect us to give you lot more assertive calls on increasing the India equity allocation, increasing your equity allocation. Similarly, we've been fairly consistent in the bond market over the last 6 months. We've been saying that you should increase your bond market exposure. Although there has been a change in Indian taxation rules, and that will impact potential returns. But as we've always said, bond funds and liquid funds are an alternative to existing fixed income allocation, which is, say, savings account as compared to the liquid fund, or fixed deposit as compared to the investing in a bond fund. And you should always keep that in mind, depending on what's your liquidity need, what is your long-term horizon, and where do you find most comfort in parking your money and feeling that it is safe, it is liquid, and it will give me that whatever return potential that you expect from a fixed income instrument. And you should always think of it in that perspective. Our multi-asset fund allocations are also, geared to this aspect where the equity allocations will slowly rising. And so is the fixed income bond allocation in terms of the attractiveness of interest rates. So if you do not have intention of directly investing on your own into choosing equity funds, I think the multi-asset fund then becomes your best outcome in terms of allocating to a broad basket asset allocation. Thank you so much, and I'll speak to you next month as usual. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.